are, you're going to need to turn that dollar into a percentage to help you on your estimate. Because what you're going to do is you're going to take your estimate of your job costs and you want to factor in your net profit and your expenses and be able to multiply the cost of goods sold times something to find out how much you need to charge. What is your estimate that it's worth for you to do that job? All right? So we got to turn that in. So that's going to tell you how much a year you're going to spend on those things. You need to figure out what percentage is that of your business. And that means how much money. So you've got to take a guess as to how much money you're going to do in a year. If you think you're going to do I'm using numbers to make it easy for them. If you can do $100,000 worth of business this year, and these all add up to $10,000, that's 10%. That means the first 10% that you make on that job doesn't come to you. It's just to pay to get the job done. It's to pay the cost of goods sold and the people that allow it to get done. All right? So that's your margin, your overhead margin is 10%. All right? So let's say, so if you were able to get what the cost of goods sold and your expenses covered, would that be break even? Right? So if you did that job and you covered your expenses and you covered your cost of goods sold, you'd be at break even. That would be zero. That's not good enough, right? So you want to get more than that. You've got to mark this job up. If you were just going to break even, how much would you mark that job up? If you found your cost of goods sold were $10,000 and your overhead's 10%, does anybody want to take a guess at how much you need to mark it up? No? Okay, good. Good. So once you've converted it to a percentage, this is the other place where I see a lot of mistakes made. Markup and margin. We're going to change the numbers a little bit. Let's say the margin target is 25% above cost. Whether it's 10% overhead and 15% net profit, which would be nice, or vice versa. Let's say you've determined you want 25% above what it costs you to do that job. If the total estimated job costs are $100,000 and you want a 25% markup, right? If you want to, at the end of the day, you've figured that you're going to do $100,000 worth of work and you want to make a 25% margin on that work. If you mark it up by 25%, you're going to get to $125,000. Your profit is $25,000. Your margin is 20%. Because your margin is your profit divided by your revenue. All right, so if you needed 25% to break even, or if 25% is what made it worth for you to do that job, you're not getting it by marking it up 25%. All right, because 25% as a percentage of 125 is only 20%. Okay, it's a little funky, but you'll see in a minute. To get a 25% margin, if that's what you need at the end of the day, so it's easier to think about the whole year. If you looked at the year and said, I'm going to do $1 million worth of business this year, and it's going to cost me $100,000 to be in business. $100,000 is 10% of $1 million. The million is your revenue. That's how much business you're going to do this year. So you're $100,000 is 10% of $1 million. It's not 10% of $1 million minus. It's not 10% of your job costs. It's 10% of your revenue, how much you're coming in. So this is your revenue. So if you need 25% of your revenue, what do you have to mark it up? If your target is 25%, the job costs are $100,000. If you multiply it times 33, you got 133. 33 into 125 is 25%. If you're not doing that, you're losing 8% margin on every job. All right? And this is the other place where sometimes oxygen leaves the room. If you don't get it, you can talk to me afterwards. It's a little complex. you have to think about it in the whole year. Like I said, if you look at what percentage your overhead is of your revenue, you've got to look at that when you're doing your markups and your margin too. What percentage is your profit of the sale price? Does that make sense? Anybody have a question about that? Make sense? Yep.
If you do an open book, how do you convey that to your clients? Because nobody wants to see a 33% mark. Well,
right. So it's a difficult call, and we've had times. I'm sorry. The question was, how do you convey that to your client? A lot of clients don't want in an open book. So this is where actually we run into problems. Nationally, people who aren't open book, it's easier. They hide it. They might even show the estimate as, this is what I'm charging and I'm making 10% profit. That's my number. They don't have to show that in that charging number, they buried a lot of profit. That's what happens a lot of times. If you're open book, like I am, I've been fighting this battle for 20 years. It's tough. What we do is we have a blended way of markup. So we will charge a higher rate on our labor than what we pay for our labor, and we tell clients. So it's the difference between cost plus work and time and material work. That's really the legal definition of cost plus work is you charge what it costs, literally. If you pay your guy $28 and his burden is $13, you're going to charge your client $41. And you're going to charge how much your 2x4 is plus the tax cost, and et cetera, et cetera. And then you're going to put a fee on it. That's technically cost plus work. And if you're doing open book or time and material or cost plus work, you need to know the difference in case you ever run into a problem. In the court of law, if you signed a cost plus contract, it's cost plus. Whatever you said the plus was, that's what you're going to get on top of your costs, and you might have to defend your costs. Time and material is a little different. Time and material work is you can charge for the materials, typically at cost, and you put the schedule in your contract. I'm charging materials at cost, and I'm charging for time. My time, my billable rate for my guys is X, right? I make about 100% markup, which is a 50% margin, by the way, on my labor. All right, so I'm making a 50% margin on my labor. I mark up my subs and my material costs 25%. So I'm only making a 21% or so margin on my subs and materials, but with my labor built in at 50% margin, it averages out and I end up with about a 25 or 26% margin at the end of the day. So that's the way most of us do it. You bury some of it, but it's transparent. We say, we're billing you $95 an hour, billing you $65 an hour, we're billing you $120 an hour, whatever it is. You pick the number, you say it to your client, and I often hear, $80 an hour, you're not paying your guys $80 an hour. And I say, no, I'm not. And I will literally tell them, but I need to make a certain amount of profit on my job, and if I charge that as a markup, you would freak out. So this is how I get there. It's part of being an open book. Live by the sword, die by the sword, right? So anyway, once you've converted that to a markup and a margin, and you do this, you take your cost of goods sold, you take your expenses, you take your net profit, everything you want to know, you figure out what your markup is, you put your markup together, and you know what you have to sell it for. All right? Is that clear? Make a lot of sense? Good. There was something missing from our current ratio before, a sort of health checkup, which I think, and this might be the most important one, and the one that, again, makes total sense. I don't think this is going to be a surprise to anybody, but this is how you know if your estimating is working. All right, you take your current ratio and you factor this in. Does anybody know what this is? Larry might. All right. We talk about it a lot in NAHB. It's some of the, but it's billings in excess of costs and costs in excess of billings. This is a modifier you need to do to your current ratio. So you take your current ratio, how much money you have, how much money you owe. You might be 2 to 1. Wow, I'm great. 1 to 1 is decent, right? You've got as much money as you need and to pay all your bills. If you went out of business today, you'd be fine. Or if the music stopped, you didn't get that next contract, the next deposit check, you'd be okay. You know, you're all right. What's missing, and what I missed for 10 years, and what most of the people I know in business are missing, is this. Billings in excess of cost. You get a deposit on a job, $250,000, nice job, $1 million job, you get 25% deposit, put $250,000 in the bank. You haven't done anything. That's a billings in excess of cost. Another way to look at it is earned. You haven't earned that money. That's not your money. That shouldn't be on the left side of that ratio. That shouldn't be your current, that's not an asset. That's not a current asset. You owe that money, all right? So billings in excess of cost. Cost in excess of billings. You've gone 2/3 of the way through a phase of the project, right? And the bank says you don't get a draw until you get X done, get the plaster up. But you're 2/3 of the way there. You've got costs in excess of what you've been able to bill, right? So that actually is on the left side. So that's how you adjust the ratio. And what a lot of people know, I mean, back in I started my business in 1986. I started my first business. And it was a heady time, the rock and roll, I call it the dark ages of building. There was some bad building going on back there. Christ, in 1984, I was remodeling and I was crappy, man. I was learning. I told you, I didn't know what I was doing. I mean, they were hiring me and putting me out there to build. So there was some shady building going on. But there was a lot of it, and people were making money, or so they thought. And a lot of people like me went out and started a business, said, hey, I can make an extra $10 an hour or $5 an hour. It'd be great. You get that deposit check. Every month you're writing out the bills, and you got 50 grand left in the bank. I'll go buy a new F-250. I'm going to get a Lariat, XLT Lariat, right? I'm gonna buy a snowmobile. This is going to be great. It's the end of the month. I paid all my bills. I got $40,000 in the bank, right? This happens all. Snowmobiles, dirt bikes, you know, whatever it is. Some of you have seen this before, right? Because you're not doing this exercise. This is a very important part. And let's see, no. We do a sheet every month, lists every single job. How much money have we gotten from them so far? How much money have we spent on their job so far? How much more is it going to cost to finish that job? How much more are we going to collect